Oh well. Today is the day where we do some analysis. Ladies and gentlemen, Asian guy here, we need to take a deep breath and look at the chart. Yesterday felt like the end of the world. Yesterday, we watched silver plunge from an all-time high of $83.62 down into a terrifying free fall that wiped out billions of dollars in paper wealth in a matter of hours. The sentiment shifted from euphoria to panic faster than an algorithm could execute a sell order. The bears came out of hibernation. The mainstream media started writing the obituaries for the silver bull run, and I know for a fact that many of you were staring at your screens, finger hovering over the sell button, wondering if the dream was over. But today, the sun came up, the markets opened, and something very specific, very technical, and very important happened. The bleeding stopped. I want you to ignore the noise. Ignore the headlines screaming about volatility. I want you to focus on one single number that flashed on the screen today. That number is $75.32. That was the low of the day. That was the exact price point where the selling pressure exhausted itself and the buyers stepped back in with a vengeance. And I'm here to tell you that $75.32 is not a random number. It is not a coincidence. It is a mathematical line in the sand drawn by the smartest money in the room. What we are witnessing right now is not a crash continuing into oblivion. It is a textbook technical defense of a critical support level. We are seeing the formation of a floor. And understanding why this floor formed at exactly $75 is the key to understanding where we go next. You have to look at the history of this rally. Go back to November and early December of 2025. Where did we spend weeks consolidating? Where did the massive volume clusters occur before we broke out to $80? We spent weeks battling in the $75 range. Back then, $75 was the ceiling. It was the resistance. Every time we tried to break it, the sellers pushed us back down. But in technical analysis, there is a golden rule. Previous resistance becomes new support. This is called the polarity principle. Once you break through a ceiling, that ceiling becomes the floor you stand on. And that is exactly what happened today. The price retraced all the way back to the scene of the breakout, tested the structural integrity of that level, and it held. It held firm. This tells us that the smart money, the institutional allocators, the industrial hedgers, the deep-pocketed whales, were waiting for this level. They didn't chase the price at $83 yesterday. They waited. They set their limit orders at $75.30, and they let the panicked retail traders sell into their hands. Think about the psychology of the market right now. The weak hands, the people who bought the top because of FOMO, are flushed out. They panic sold yesterday when they saw red. But the strong hands, the entities that actually need the physical metal for solar panels and electronics, know that the fundamental shortage hasn't changed. They saw the price drop to $75 and they saw a discount. They stepped in and built a wall. And this isn't just about price memory, it is about volume. If you look at the volume profile of the last 2 months, the thickest cluster of trading activity is right here at $75. This means there's a massive amount of vested interest at this level. There are millions of contracts that were bought here. Those buyers are defending their positions. They are not going to let the price slip below their average entry without a fight. So while the uneducated trader looks at a drop from $83 to $75 and sees a crash, the professional trader looks at a drop to $75.32 and sees a retest. A retest is healthy. A retest confirms that the breakout was real. A retest builds the foundation for the next leg higher. We are not looking at a dead cat bounce. We are looking at a market that is shaking off the leverage, finding its footing, and proving that the bull market structure is intact. The floor is in. The panic is over, and now we need to look at the specific algorithmic triggers that fired today, because the machines are trading this level just as aggressively as the humans. Let's look at the Fibonacci levels and the moving averages, because they align perfectly with this $75 thesis. And this brings us to the machinery beneath the surface. We have identified the floor at $75.32. We have identified the human psychology that turned previous resistance into new support. But to understand why this specific number held with such ferocity, we have to look at the market through the eyes of the entities that actually control the price action. I'm not talking about the retail traders. I'm not talking about the gold bugs on Twitter. I'm talking about the algorithms. In the modern financial ecosystem, 70% of all trades are executed by machines. These machines do not feel fear. They do not feel greed. They do not care about geopolitical headlines or what the Federal Reserve chairman had for breakfast. They care about math. They care about specific, hard-coded data points that trigger billions of dollars in automatic buy orders. And today, at the lows of the session, silver hit a mathematical coordinate that is so perfect, it is almost suspicious. Let's talk about the Fibonacci retracement. I know some of you roll your eyes at technical analysis. You think it is tea leaves, but the algorithms run the world, and the algorithms are programmed to respect the golden ratio. If you take your charting tool and draw a line from the absolute bottom of the rally in early November to the absolute top of the rally yesterday at $83.62, you get a series of retracement levels. These are the levels where a correction is statistically likely to stop. The first level, the shallowest, most aggressive level of support, is the 23, 6% retracement. Do you know what the exact price of that 23, 6% level is? It is $74.80. Now, look at the low of today, $75.32. We came within 50 cents of the 23, 6% line and bounced. This tells us something incredibly important about the health of this market. In a weak bull market, or a market that is losing momentum, the price usually corrects to the 38, 2% level or the 50% level. It needs to go deeper to find buyers. It needs to offer a bigger discount to entice the money back in. But in a hyper-bullish market, a market where the demand is overwhelming and the supply is non-existent, the price barely corrects at all. The buyers are so ravenous, so desperate to get in, that they step in at the very first mathematical opportunity. They front-run the deeper correction. Holding the 23, 6% level is a show of extreme dominance. It is the market telling us that the dip is not allowed to go deeper. The algorithms calculated that $74.80 was the fair value for a shallow pullback, and the human traders were so scared of missing out that they bought just above it at $75.32. They didn't even let it touch the line. They front-ran the robot. That is the definition of strength. That is the definition of a market that wants to go higher, not lower. And there is another line on the chart that tells the same story. Let's look at the 20-day moving average. Currently, the 20-day moving average sits at $73.50. This line represents the average price paid for silver over the last month. In a normal correction, the price will often touch this line to revert to the mean. It is a healthy reset. But today, we didn't touch it. We didn't even get close to it. We bottomed nearly $2 above the 20-day average. This phenomenon is called front-running the mean. It happens when institutional capital is chasing the asset. Imagine you are a fund manager at BlackRock or Vanguard. You have a mandate to allocate $500 million into silver because your analysts are screaming about the solar shortage. You missed the move to $83. You're praying for a pullback. You see the price dropping, 80, 78, or 76. Your model tells you that the fair value average is $73.50. Do you wait for $73.50? No, because you know that everyone else is waiting for $73.50. You know that if you wait for the perfect price, you might get nothing. So you pay a premium. You put your buy order at $75. You pay $2 over spot just to guarantee execution. That is what we saw today. We saw billions of dollars of capital deciding that paying a premium above the average was better than risking missing the boat completely. This creates a dynamic floor. The floor isn't static, it is rising. The buyers are stepping up the ladder, meeting the sellers higher and higher. This confirms that the trend is not just intact, it is accelerating. In a dying trend, price crashes through the moving averages. In an accelerating trend, price floats above them. We are floating. But the most compelling evidence for the $75 floor isn't just where the price stopped, it's volume. Volume is the fuel of the market. Price is the car, but volume is the gas. You can't fake volume. If you look at the volume profile for the last 2 months, you will see a massive bulge in the chart right around the $75 level. This is what we call a high volume node. Back in late November and early December, when silver was first breaking out of the 60s, we spent weeks churning in this $75 area. Millions of contracts changed hands here. Why does that matter now? Because every single one of those contracts represents a memory. Think about the trader who bought at $75 back in November. When the price went to $83 yesterday, he was a genius. He was up huge. But when the price crashed back down to $75 today, he wasn't scared. He was back to break even. And more importantly, the trader who sold at $75 in November, the guy who bet against the rally and got squeezed, he has been suffering for weeks. He watched the price go to $83 and wished he could get out of his short position without losing his shirt. Today, the market gave him a gift. It came back to his entry price. So what does he do? He buys to cover. He buys to close his losing bet at break even. This creates a double layer of buying pressure. You have the bulls defending their entry, and you have the bears covering their mistakes. Both sides are buying at $75. This turns the level into a liquidity sponge. It absorbs selling pressure. You could throw $1 billion of sell orders at $75 right now, and the sponge would soak it up without the price moving a cent. The volume node is too thick. The interest is too high. This is why technical analysts say previous resistance becomes new support. It isn't magic. It is the mechanics of regret and relief. The sellers who regretted selling at $75 are now relieving their pain by buying back. The buyers who regretted not buying enough at $75 are now relieving their FOMO by doubling down. It is a perfect storm of accumulation. And we have to talk about the November outage spike. Do you remember November 11th? The day the CME had that glitch? The day silver spiked to $56 and then crashed, only to rip higher later? That $56 level was the old floor. Now, $75 is the new $56. The market structure has shifted up a gear. We have graduated. We are no longer trading in the industrial commodity range. We are trading in the monetary metal range. The fact that we flushed 14% in 24 hours and still held $75 is the most bullish signal of the entire year. A weak market would have given up $75. It would have tested 70. It would have collapsed to 68. We defended the line. So when you combine the 6% Fibonacci retracement, the front running of the 20-day moving average, and the massive volume sponge at $75, you get a structural fortress. This is not a floor made of wood. It is a floor made of concrete and rebar. The algorithms know it. The institutional desks know it. And now you know it. But knowing the floor there is only half the battle. The other half is spotting the recovery signals. How do we know the selling is truly over? How do we know the bears are exhausted? We have to look at the shape of the candle on the daily chart. We have to look at the RSI, and we have to look at the money flow, because while the price was stabilizing at $75, something very interesting was happening under the hood. The hammer was forming, and if you know your candlesticks, you know that a hammer at a key support level is the death knell for the bears. Let's look at the recovery signals that are flashing green right now. Let's look at why the smart money spent all day buying while the retail money spent all day crying. The evidence is in the chart, and it is undeniable. We have established the mathematical floor at $75.32. We have seen the algorithms defend the Fibonacci levels, but now we need to look at the footprints left by the battle itself. If you open your daily chart right now, and I mean the daily time frame, not the 5-minute noise, you will see a specific shape forming. It is one of the most powerful and reliable patterns in all of technical analysis. We are forming a hammer candle. Look at the shape of today's price action. We opened the day under pressure. The sellers pushed the price all the way down to $75.32, trying to break the floor. They tried to induce panic. They tried to trigger a cascade. But then something snapped. The buyers stepped in. They absorbed every single sell order and pushed the price all the way back up. This leaves a long lower shadow on the chart, a long tail that points down to the lows with a small body near the highs. This is the hammer. And a hammer tells a very simple story: rejection. The market rejected lower prices. The market went down to look for value, found it, and bought it up aggressively. It is the visual representation of a V-shaped intraday recovery. When you see a hammer form exactly at a key support level like the 6% Fibonacci line, it is a high probability reversal signal. It tells you that the bears ran out of ammunition. They fired their best shot, they pushed as hard as they could, and they failed to hold the ground. But the hammer isn't the only signal flashing green. We have to look at the relative strength index, the RSI. Yesterday, when we were crashing, everyone was screaming that silver was overbought. They said the RSI was too high, that it needed to crash to reset the momentum. Well, look at the RSI today. Did it crash to 30? Did it go to oversold territory? No. It bounced off 65. This is incredibly significant. In a weak market, a correction takes the RSI all the way down to 40 or 30. It fully resets the engine. But in a supercycle, the asset stays in overbought territory for months. The fact that we bounced at 65, a level that is technically still considered high, shows extreme underlying strength. It shows that buyers are so eager that they aren't waiting for a deep discount. They are stepping in while the momentum is still hot. This is what we call a bullish range shift. The RSI isn't oscillating between 30 and 70 anymore. It is oscillating between 60 and 90. The entire floor of momentum has shifted up. This confirms that the $75 level isn't just a floor for price, it is a floor for momentum. The market is refusing to cool off. It is refusing to let the bears take control for even 24 hours. And finally, we have to talk about the most important indicator of all, volume. Look at the volume bars at the bottom of your screen. Yesterday, during the crash, the sell volume was high. It was panic selling. But today, as the price dipped to $75, look at what happened to the volume. It dried up. This is called volume exhaustion. It means that at $75, there was simply nobody left to sell. The weak hands were gone. The panic sellers had already exited. And as the price started to bounce back up, the volume started to rise on the buy side. This is the signature of smart money accumulation. The institutions wait for the selling to stop. wait for the volume to die down, and then they quietly start scooping up contracts. They don't want to spike the price too fast. They want to fill their bags. The declining volume on the pullback, followed by rising volume on the recovery, is the classic footprint of a successful test. So when you combine these three signals, the hammer candle rejecting the lows, the RSI holding bullish territory at 65, and the volume exhaustion showing no more sellers, you get a technical setup that screams buy. This is not a chart that is about to roll over. This is a chart that just shook off the passengers and is refueling for the next leg up. The technical damage from yesterday has been repaired in a single session. The $75 floor held, the hammer confirmed the defense, and the momentum is already curling back up. But technicals are only half the story. Technicals tell us where the price stopped. They don't tell us who stopped it. To understand the true durability of this floor, we have to look at the money flow. We have to look at who was actually buying today. Because, while the retail traders were licking their wounds, the biggest players in the market were making a move that proves they believe the bottom is in. In the next part, we are going to look at the ETF inflows and the physical market activity. We are going to see exactly who stepped in at $75.32. And spoiler alert, it wasn't the day traders. It was the heavyweights. Let's follow the money. If you listen to the mainstream financial news, they will tell you that the silver market is in turmoil. They will tell you that investors are fleeing volatility. But we don't listen to narratives. We look at the flow data. We look at the actual movement of cash into and out of the major funds. And the data from today paints a picture of massive institutional accumulation. Yesterday, Monday, we saw outflows. That was the retail panic. That was the weak hands puking their positions at the lows. But today, the tide turned completely. We are seeing net positive inflows into the major silver ETFs. The big funds, the ones that move markets, didn't sell the breakdown. They used the breakdown as a liquidity event to fill their orders. When you see the price stabilizing at $75 while ETF holdings are rising, that is a divergence that screams accumulation. It means that for every retail trader who sold a share out of fear, a large institution bought that share out of conviction. The ownership of the silver market is transferring from the nervous to the confident, from the leveraged speculator to the long-term allocator. But the paper market is only half the story. The real defense of the $75 level came from a much more powerful source, the physical market. We have reports from the commercial desks that industrial buyers, the companies that actually consume silver for solar panels, electronics, and batteries, have been sitting on massive buy orders right here in the $75 to $76 range. You have to understand their mindset. A solar manufacturer doesn't care about the RSI. They don't care about the daily chart. They care about securing inventory for production. For the last 2 weeks, as the price ran up to $83, they were priced out. They stepped back. They let the speculators play. But the moment the price dropped back into their buy zone below $76, they pulled the trigger. This is what we call the industrial put. It acts like a floor under the market. Whenever the price drops to a level where it makes economic sense for the factories to restock, they step in and buy everything in sight. They are the ultimate value buyers. And today, they signaled clearly that $75 is the price they are willing to pay. This confirms that the demand isn't speculative, it is structural. Speculators run away when the price drops. Industrial users run towards the price when it drops. The fact that we bounced so cleanly off $75 tells us that the physical hunger for silver is still insatiable. And there is one more group of players we need to watch, the commercial hedgers. These are the bullion banks and the producers who usually bet against the price rising to hedge their inventory. Historically, they are the shorts. But look at the open interest data today. It is stabilizing. We aren't seeing a massive spike in new short positions to drive the price down further. Instead, we are seeing signs that the commercials are actually covering some of their shorts. They are using this dip to reduce their risk. Why would a bank cover its short position at $75 if they thought the price was going to $50? They wouldn't. They cover because they know the downside is limited. They cover because they respect the strength of the trend. When the smart money stops shorting and starts covering, it is often the precursor to the next massive leg higher. They are clearing the way for the bull run to resume. So put it all together. We have ETFs seeing inflows, proving that investment money is returning. We have industrial giants stepping in below $76, proving that physical demand is rock solid. And we have the commercial banks reducing their short exposure, proving that they don't want to bet against this floor. This is a triple confirmation of the $75 support level. It wasn't just a technical bounce, it was a fundamental rejection of lower prices by every major class of buyer in the market. So the floor is built. The players are positioned. The weak hands are gone. But now we have to look forward. Now that $75 has held, what is the path back to the highs? Because the market never moves in a straight line. We have obstacles ahead. We have the Federal Reserve minutes coming out. We have the dollar index threatening to break out. In the next part, we are going to lay out the specific roadmap to $90. We are going to look at the technical targets, $78, $82, and beyond. And we are going to discuss the one risk factor that could still threaten this recovery. We have survived the crash. Now we have to navigate the recovery. Let's look at the targets. To truly trust this floor at $75, we have to understand the invisible forces that are holding it up. We have to answer the question, why did the selling stop here? Why not $70? Why not $60? There are three pillars supporting this $75 level. Three distinct forces that have combined to turn this price point into concrete. And you need to understand each one of them to have the conviction to hold through the turbulence that is coming later today. The first pillar is the psychology of the round number. Human beings are simple creatures. We like clean, divisible numbers. We don't think in terms of $74.37. We think in quarters. 25, 50, 75, 100. These are the quarter century marks. They act as psychological magnets. For the last 2 months, $75 was the line in the sand. It was the resistance level that every trader on Wall Street was watching. It was the breakout level. When we finally smashed through it in early December, it was a moment of euphoria. It signaled that silver had graduated from the mid-range to the high range. Now that we have crashed back down, $75 has become the defense line. It represents the legitimacy of the bull market. If we hold $75, the narrative remains. Silver is a $75 asset that is heading to 100. If we break $75, the narrative shifts to silver was a fake breakout and is heading back to 50. The entire psychological structure of the market depends on this number, and the traders know it. That is why the defense was so fierce today. It wasn't just about protecting a price, it was about protecting the story. The bulls knew that if they lost $75, they lost the credibility of the trend. So they drew a line. They put their backs against the $75 wall and said, no further. This psychological anchoring is powerful. It creates a self-fulfilling prophecy where buyers step in simply because they believe other buyers will step in. It turns a number on a screen into a fortress. The second pillar supporting this floor is the priced-in phenomenon regarding China. Everyone is terrified of the January 1st export licenses. The bears have been using it as a weapon saying, oh, maybe the ban won't happen, or maybe the market will crash when the liquidity dries up. But think about where we are. Today is December 30th. The news is out. The deadline is known. The fear has been digested. The crash we saw yesterday? That was the market pricing in the worst case scenario. That was the market bracing for impact. But here is the secret of financial markets. The crash usually happens before the event, not during it. By dropping to $75, the market has essentially discounted the risk. It has already taken the hit. So now at $75, the China risk is no longer a headwind, it is a tailwind, because the price has effectively said, okay, even if the export ban causes chaos, $75 is the fair value for that chaos. Any news that comes out now, any confirmation that the ban is strict, any report of shortages is upside fuel. The downside has been exhausted. The bad news is in the price. The sellers who were scared of January 1st have already sold. Who is left? Only the people who believe that January 1st is the start of a squeeze. This transition from fear of the event to pricing of the event is what creates a floor. You can't scare the market with the same story twice. The shock value is gone. And when the shock value is gone, the price stabilizes. The third pillar, and perhaps the most tangible one, is the industrial value proposition. We touched on this in the money flow section, but we need to go deeper. You have to understand the terrifying reality of a just-in-time supply chain manager at a company like Samsung or Tesla. These people do not speculate. They have a factory to run. If they run out of silver, the assembly line stops. If the assembly line stops, it costs the company millions of dollars an hour. For them, the price of silver is secondary to the availability of silver. When silver ran to $83, they were nervous. They held back orders, hoping for a dip, sweating as their inventory levels dropped. When silver crashed to $75 yesterday, they didn't panic. They celebrated. They saw a window. A brief, fleeting window to restock their warehouses before the January 1st curtain falls. They know that in 48 hours, the rules change. They know that getting metal out of China is about to become a bureaucratic nightmare. So $75 became the panic buy level for industry. Not panic selling, panic buying. They are grabbing every ounce they can find below $76 because they would rather pay $76 today than risk having zero metal next week. This industrial bid is the hardest floor of all. Speculators can change their minds. Algorithms can be reprogrammed. But a factory cannot run without raw materials. That demand is inelastic. It is not going away. And it is sitting right here at $75, absorbing every sell order the paper market throws at it. So we have the psychological fortress, we have the priced-in event, and we have the industrial safety net. These three forces create a formidable support structure. It explains why the crash stopped dead in its tracks. But, and this is a very big but, we are not out of the woods yet. I would be lying to you if I said the path to $90 is clear. It isn't. There are landmines ahead. There are specific risks that could crack this $75 floor and send us tumbling down to the next support cluster at $70. And the biggest landmine is sitting right in front of us, ticking down to this afternoon. We have to talk about the Federal Reserve minutes. Today is Tuesday. Later this afternoon, the Fed is going to release the minutes from their last meeting. Why does this matter for silver? Because silver is priced in dollars, and the Fed controls the value of the dollar. The market is currently on edge. Traders are nervous that the Fed might sound hawkish. If the minutes reveal that the central bankers are worried about inflation, if they hint that they might keep interest rates higher for longer, or even raise them again, it will be like lighting a match in a gas station. A hawkish surprise would send the US dollar skyrocketing. And when the dollar spikes, silver usually drops. It is the seesaw effect. Dollar up, commodities down. This is the biggest immediate threat to our $75 floor. If the algorithms read the Fed minutes and decide that the dollar is the place to be, they will dump silver futures instantly. They won't care about the hammer candle. They won't care about the industrial demand. They will execute the dollar strength correlation trade. We could see a sudden violent test of $75 the moment those minutes hit the wire. We could see a fake out spike down to $74 just to run the stops. You have to be prepared for this. You have to understand that this afternoon's volatility has nothing to do with silver and everything to do with the dollar. And speaking of the dollar, we have to talk about the DXY index. The dollar index is currently hovering near extremely dangerous levels. It is flirting with the 110 level. If the DXY breaks above 110, it is a wrecking ball for global markets. A super strong dollar sucks liquidity out of the system. It makes commodities expensive for emerging markets. It puts pressure on gold and silver. Right now, silver is fighting a headwind. It is trying to rally despite a strong dollar. That is actually a sign of incredible strength. Usually, silver collapses when the dollar is this high. The fact that we are holding $75 with the DXY at 109 is a miracle. But if the DXY punches through 110, the pressure might become too much. The dam might crack. We have to watch the currency markets like a hawk today. If you see the dollar index ripping higher, do not be surprised if silver feels heavy. Do not be surprised if we revisit the lows. And finally, there's the China policy risk. We are all assuming that the January 1st export licenses are going to be strict. We are assuming it is a de facto ban, but what if it isn't? What if the details come out, and they are, soft? What if China issues a huge number of export quotas? What if the market realizes that the supply constraint isn't as bad as we thought? That would be a deflationary event for the silver price. The premium in Shanghai would collapse. The arbitrage would close, not by New York going up, but by Shanghai coming down. This is the black swan that nobody is talking about. Everyone is positioned for a shortage. If the shortage turns out to be a bureaucratic nothing burger, the $75 floor could give way. I don't believe this will happen. The geopolitical tension suggests China wants to weaponize resources, not share them, but as a risk manager, you have to acknowledge the possibility. So here's the reality of the situation. We have a solid technical floor at $75. We have massive buying interest. The setup is bullish, but we are standing on a trapdoor. The Fed minutes, the dollar strength, and the China details are the three latches holding the trapdoor shut. If one of them snaps this afternoon, we could see one final flush. We could see a terrifying drop to $72 or $70 before the real recovery begins. However, if we survive this afternoon, if the Fed minutes are neutral, if the dollar stays below 110, then the path of least resistance is higher, much higher, because once these immediate risks are cleared, there is nothing left to hold the beach ball underwater. The industrial demand will take over, the technical buyers will chase the momentum, and the $75 floor will become the launch pad for the next leg of the bull run. So, what are the targets? If $75 holds through the Fed noise today, where are we going tomorrow? Are we going back to $80? Are we going straight to $90? In the final part of this update, I'm going to map out the specific price targets for the recovery. I'm going to give you the measured move that points to a retest of the highs sooner than anyone expects. And I am going to leave you with one key message about the difference between a correction and a crash. We have survived the bloodbath. Now we have to navigate the recovery. Do not let the Fed shake you out. Let's look at the targets.